Globally, stock markets are bullish. Dow Jones, Nikkei, and Kospi are at record highs. There are indications of trade tensions declining. The possibility of a US-China trade deal is improving. What are the prospects for the Indian market? Welcome to Geojit Spotlight. Nifty is still trading a few hundred points below the record 26,277 reached in September last year. We know that the poor performance of the Indian market during the last 1 year has been caused mainly by three factors. One, the poor earnings growth, which declined to 5% in FY25 from 24% CAGR during the 3 years before that. Two, massive selling of stocks worth around $21 billion by foreign institutional investors. Three, the unjustifiable 50% tariffs imposed on India by President Trump. It is important to understand that these three negative factors are turning positive now. This is favorable for a rally in the market, a modest rally, not a sustained bull run. This festival season has been reporting brisk sales of goods, particularly automobiles and white goods, to an extent FMCG also. 1 lakh cars were sold in 1 day. October 19th sales figures from business and trade associations indicate about 6 lakh crores of sales. This is a sharp surge compared to previous festive seasons. There is a big consumption boom going on. This festive season sales will come down after some time, but the tempo is likely to continue with decent growth. This will enable earnings recovery in FY26 and impressive earnings growth in FY27. The market will start discounting this. Regarding FII activity, FIIs have substantially reduced their selling and have turned the buyers in recent days. This augurs well for the market. Regarding tariffs, the element of uncertainty remains, but recent comments from US Treasury Secretary Scott Bessent indicates that the US has climbed down from its stance with China and is likely to reach an agreement with China very soon. This will pave the way for an India-US trade deal also. We will have to wait and watch how this pans out. Coming to market, let me summarize with a few important points. One, investable stocks in India can be broadly classified into two categories. This is a broad classification: growth stocks and value stocks. Growth stocks have long period of growth ahead of them. They are highly valued. Value stocks have only modest growth prospects. Their valuations are reasonable. They are not cheap, but the valuations are comparatively reasonable. Two, sectors like digital platform companies, capital market related stocks, renewable energy stocks, defense stocks, etc. are growth sectors. Sectors like banking and financials, including NBFCs, FMCG, white goods, commodities like cement metals, etc. are value sectors. 3. IT is on a slow growth lane with only 4% growth in revenue expected this year. But mid-cap IT stocks like Coforge and Persistent Systems are doing very well. Pharmaceuticals are posting decent growth, and they will continue to post decent growth in the days, months, and years ahead. So, which sectors and stocks an investor should select? This will depend on the investor's risk profile and investment time horizon. That is, how much risk the investor can take and how long he or she will be prepared to wait for returns. Considering these factors, invest cautiously.